How's everyone doing today? Woo-hoo! Awesome. So first off, thanks again, Wences, for having me come through. Actually flew in from Miami. That's why the white pants, if you guys are wondering. It's kind of rubbed off a little bit on me, so pretty cool. But originally from LA, so can't beat the weather here. But with that said, guys, really the whole smart money concept, I love it. Fell in love with it as soon as Wences really told me all about what he's got going on here with Build. And so I'm going to go and dive deeper into what's beyond kind of the traditional investments that we talk about with stocks and Roth IRAs, bonds. Like, that's all really great stuff. But like Wences mentioned, there's a lot that's changing in financial markets right now. And being at the forefront of that, we'll probably see things change over the next 24 months, like you mentioned. So I'm going to go over really the alternatives and the things that are outside of some of the traditional stuff you may find online, and why those are becoming more and more attractive. And so first off, disclaimer, I'm not a financial advisor. That's why you're gonna go to Carl instead of me, okay? So with that said, really the agenda for today, I wanna set the foundation first of what money is and how the US dollar really works. And then we're gonna go over kind of how the fiat system works, and then go over, the rise of alternatives and essentially how, they are actually outperforming in a lot of cases some of the traditional stuff that we've been taught. So with that said, a little bit about me, again, from California, got into crypto before all the traditional kind of stuff back in 2015, 2016. And really that opened my mind to just, seeing different things differently, seeing investments differently, seeing businesses differently. And over the past 5 years, I've dedicated my career to really just doing alternative type of business routes. So we have, e-commerce companies, we have our own algorithmic trading software companies, we have our own crypto fund that Wences and I have started, and we actually have some talent coming from BlackRock. So all of these things kind of combined really encompass what I'm all about, which is, hey, that everything's changing and there's new ways, new technologies, and alternative ways to make money and have better investments, okay? So with that said, let's first talk about what money is. And usually what people are told what money is from, presentations or from videos, from what we've been traditionally taught. And that is money is a medium of exchange where we, trade it back and forth in order to buy the goods and services that we want. And that allows a society to function. It allows us to not have to barter my chickens for a gun, right? Like, it actually provides some order in our society. But if you have ever been in marketing and sales or any of those types of positions and roles, that's usually what people will talk about with features and benefits. Like, what does the thing do for you, but not really describe what the technical features of it are. So this, to me, because I come from a big marketing and sales background, a little bit about my history is I used to work for Grant Cardone and I used to do a bunch of marketing agencies and stuff. This screams to me selling a product. And so there's actually more that goes behind money than, what meets the eye. So we have to first look back in time as to, okay, how did we get to that narrative? How did we get to that kind of sentiment about what money is? And so many people don't know that actually the US dollar used to be backed by silver, and then it was gold and silver, and then it was mostly gold. And you can see the timeline here, but back in the mid 1940s is when we started to print more money, and where gold wasn't a 1-to-1 ratio anymore. It started to actually dwindle down a little bit. And up until 1971, we had Richard Nixon completely take us off the gold standard. So what that means is that the US dollar isn't backed by gold anymore, right? And when we take a look at kind of what it's backed by, it used to be backed by a commodity. It used to be backed by gold, or a physical asset that you can touch, you can see, and that everyone accepted as money. But now we see that it's backed mostly by these following things: a basket of commodities. So the US in aggregate as, its energy supply, its resources, water, things like that are natural on this planet, including gold. 2 is the productivity of a society, because that entire timeline, like I mentioned prior, the entire time that the US dollar was, being circulated in economies and becoming the thing that people wanted to use, everyone just kind of adopted it, right? So if you have that adoption of people using a certain currency, you can see it change over time and not see the demand change, okay? So what the goal becomes then is, how do we consistently have the US dollar have demand? Like, how do we continue to make this thing be used? Why do we continue to use it, right? All of this is built on the deals that we have across the world. So the oil market, for example, we had a negotiation with Saudi Arabia that, hey, you use our US dollars to trade your oil and we'll protect you with our military, right? So we have that agreement there securing transactional volume, okay? And that's basically just the change of hands between, the currency for the goods that we want, for the services that we want, et cetera. Now, that also begs the question as to, okay, if it's backed by the deals that we have and our military strength, well, the third pillar is our allies. Who else is supporting that vision, that mission, everything about what the US dollar represents? And so then, if we take a step back and say, okay, that's what the governments are doing. That's what they're doing to secure our sovereignty here in the United States. They're securing our currency. But what do they do with us as citizens of the United States, or the people that are supposed to be using it? Well, it's all about the belief, right? So America has its own great propaganda machine, and the belief in the US dollar is what keeps it going, right? Where it's not backed by anything other than these things mentioned here. So if we look at it from a business perspective, it is the #1 product made by the US government. They can print as much as they want, and it still has the demand. And by the way, if it doesn't have as much demand anymore, they use the military. So you might want to use it, right? So when you have that kind of situation and that advantage over other countries, you then have to think of, okay, what's the playbook that they're running? This is obviously not, brand new. They didn't come up with this. This has to be used in today's markets and prior markets and, prior civilizations. So what do they actually do? Well, we can look at this by studying what companies do that have great cash flow management. Like Carl said, great cash flow management and a great cash balance. Well, what they do is, instead of just spending all that cash, they actually lever up. If they know that they're making X amount of money every single month, or X amount of money every single quarter, like Apple, they sell iPhones like crazy, they sell MacBooks like crazy, they can take on debt. And so by doing that, not only do they have their cash, but then they also have the ability to use debt. So in this example here, this is actually a screenshot from CNBC. Apple has about $162 billion worth of cash currently, but they also have about $100 billion worth of debt. So why would they do that if they have the cash to buy things, right? Well, now they have $262 billion available, backed by their cash flows, in order to actually invest into projects, R&D, and that's what you do in a business sense. But when it comes to the currency itself, if we change it back to the government and the US dollar, well, they can continue to print because it's backed by our belief, our productivity, it's backed by the military strength and the positions that we have here in the world. So this is just the past 10 years, 10, 12 years here of the US dollar being printed. The metric for that, if you guys look it up on Google, it's called M2. It's the total money supply that's out in the world. But at the same time, if we extend it out on a bigger time horizon, this is over 100 years. Over 100 years, the currency goes to zero. And the reason it goes to zero is because they print more and more and more and more, but there's not necessarily new value created. So it's kind of like, a McDonald's hamburger 50 years ago, it's a lot different now. Probably really good ingredients back in the day. Now, not so much. And it's because, again, in this example, they're devaluing the currency that we store our time and energy in, right? We go sell, make $7,000, $10,000 commissions, make really good money. But if you hold that over a long period of time, well, that $7,000 to $10,000 isn't worth $7,000 to $10,000 anymore. I remember my grandpa, he recently passed away, but he used to say like a nickel would buy him like a 5-course meal. I'm like, dude, what era were you living in? Like, that's insane, right? Versus now. So the currency itself with any government, it'll always go to zero over a long enough time period. And so this isn't anything new. It's just understanding the way that the currencies are built. So these are the past 4 cycles, past 3 cycles here. If you guys haven't been studying Ray Dalio, this is from his book called Principles in the Changing World Order. where it essentially shows that there's a rise and a fall to all nations. And with it goes their currency. So the US is going to want to continue to keep its reserve currency status. It's going to continue to want that volume. But we're starting to see countries actually try and overthrow the US dollar. If you guys have heard the word BRICS or what's going on with the SWIFT system, long story short, these countries on the other side of the world are kind of tired of the US's financial system, and they're wanting to build away from it to have their currency go on its rise. So we talked about what happened the past 12 years or so with printing, but when COVID hit in 2020, we printed 40% of the money supply in the entire history of the US government, 40% more within a year and a half. 40%. Now, I don't know about you, it's not like our businesses necessarily grew by 40%. It's usually that labor got more expensive, and so we saw inflation because we started printing money. Okay? Got a little crazy with it. So, inflation happened, right? It's still somewhat there because too much money chasing scarce goods causes the price of that thing to rise. We can see that with food, we can see that with energy in some cases, but we can also see it with all assets, stocks, real estate, other assets that started to soar, even Bitcoin. But that's usually driven, or it has historically been driven, by simply the printing of more money over time. It's not necessarily that the value of things were, becoming more economical or they're giving a good benefit. It's just because we were printing more money that it rose with the stock market. So the blue line here shows the rate of the printing that's happened over the past 10 or 15 years here, and that's the stock market. A tight correlation because they're printing more money, and that money has to go somewhere. It has to go into an asset, either gets spent back into the economy, which causes, again, more money chasing fewer goods. This happens over and over and over. So the S&P 500 is basically keeping up with the money supply. Over the past 60 years, the average rate of the money supply increase has been 7% per year. And we talk about, hey, 7% per year is a great return on your investment. Well, it's because you're basically following the printing of money. So your account balance may go up, but maybe you don't feel wealthy. You don't feel like you can buy more things. Well, that's why. You're just keeping up with the rate of the printing, which is also causing the rate of these goods to go up over time. Making sense so far? Cool. Awesome. So how does that actually affect investments? Well, like I said, you're basically keeping up with the printing. So here's a graph here. All of these lines, there's a little bit of an overlap, but if you look at the bottom left, the pinkish red line is what a checking account will give you. So if you got your $10,000 commission with Build and you just kept that 7 to 10 in your checking account, you're not going to be earning really any interest on that. Maybe 0.01% if you're lucky. If you move that to a savings account, a high yield saving or a CD, you may get 4.5% now because the Fed interest rates are about 5. So you're not keeping up, but you're still kind of there. The red line here is the printing of money rate, 7% per year. So the black lines that I put are the S&P 500's returns. So you're barely going above where that money supply line is. And so when we look at it just from that perspective, the hurdle rate is basically the rate at which that it's going to happen regardless. Like they're going to print money every single year regardless. It's going to continue probably to go up by 7%, if not more. And that's the hurdle rate. Like if you just put your money in the stock market, made 7%, and they printed 7%, cool. That was going to happen regardless. So when you are trying to look for investments, you have to look for things that can outpace that. So that way you're actually making a compounded return on your money. So this is where I got into alternatives because I was like, okay, if stocks, bonds, all that kind of stuff is just going to either keep up or, guarantee lose me money, I got to look for things that are going to continue to compound or give me a better risk reward ratio. So there is a green line at the very, very top and a purple line somewhat further down. Now this comes down to taxes a little bit, but if you hold something for a short amount of time in the markets, it's called short-term capital gains tax, where you get taxed more if you make a profitable trade. So if I made a $10,000 trade, it went up to 20 grand and I did that in a week, well, I would owe 50% of my gain in taxes, okay? If I hold it over 1 year, then I only owe 20%. Okay, so if I did the same trade, but it took 1 year, I would only owe 20. So if you're doing things on a short-term basis, you have to make 40% a year, so that way post-tax, you're compounding your money above the rate of the print and still making 13% per year. Okay, if you have something with a long-term kind of outlook and you hold it for over a year, then your return threshold can drop to about 20%. And you're still making money above the line of the money print. Okay? You guys following? Does that make sense? Okay, cool. So that's what made my fascination for alternatives, again, freaking made me super excited. I was like a kid in a candy shop. And so that's what I've dedicated my career towards. And so the question then becomes, like, how do you outpace that money supply and achieve more growth in your portfolio? Well, the traditional way, like I said, was stocks, bonds, efficient tax planning, real estate, insurance, but it's only going to get you so far. And no, I'm not saying, take your 401k, your Roth IRA, that kind of stuff and just completely dump it. I'm not saying that in any way, shape, or form. But it just is a good thinking and a good exercise to go through when it comes to, how you're making money and how you're making it compound. The most basic way that I would say is great to compound your money is to invest back into your business, back into your lead flow, back into your systems, because what you build with Build or other businesses that you may have outside of this, your best investment is going to be in yourself to earn more money. So by joining the Smart Money Club, learning more about this stuff, you'll be able to make better decisions. By, again, having an opportunity for high commission checks gives you those lump sums to be able to compound them and actually do something with it. Okay? You can't invest a penny and think it's going to, make you $1 billion. Those days of Bitcoin are over. Okay? So the aggressive way to do it is by active trading or by investing more into speculative investments. Okay? Obviously, you can get very high risk when you do this, but this is what a lot of people are doing now. So this graph here shows the family office allocation from some of Citibank's highest clientele. If you don't know what a family office is, basically there's a point in which that you have a lot of money, and instead of hiring a lawyer over here, hiring a tax guy over here, and then maybe your buddy from a long time ago, manages your books, you start to bring it all under one roof because it just gets more complicated to have to bring in a bunch of people from different companies, okay? So think of it like your own little Navy SEAL team working on your tax efficiency, financial planning, and that kind of stuff, okay? So this is how they currently allocate their portfolio. Now, a couple years ago, it was the traditional route of 60-40 stocks and bonds. But now we're seeing family offices adapt alternative investments because that stuff only has so much upside. So we're seeing now they've allocated their portfolio to include some moderate strategies with private equity and more of an aggressive allocation with 12%. It used to be that family offices would only allocate 2 or 3% to speculative stuff or higher risk things. But now they're starting to open up their portfolios to have more exposure, okay? So with that said, let's go over a few aggressive strategies. And I'm just showing this to show you what's out there and what's happening right now. I have my beliefs about Bitcoin and all that kind of stuff because we have a fund, but I'm doing this to demonstrate and illustrate some of the things that are out there and happening right now. So like I said, one of my partners is at BlackRock. He works with us on our fund. And he was part of helping the Bitcoin ETF project actually come to fruition. And so recently, if you guys haven't been paying attention to Bitcoin specifically, Bitcoin was created, the product of the ETF was created by BlackRock, Fidelity, etc. And it was the most successful launch that they've ever had for their financial products in history. Okay, they had over $50 billion of inflows within just the first few months of making this offer available to their clients. So before Bitcoin, you had to buy it on an exchange or maybe buy it from a buddy of yours if he was into that kind of thing. But now institutions are making it available. And so with that amount of money coming into an asset class from big people like BlackRock, Fidelity, that kind of stuff, it makes you think obviously times are changing. This isn't like the currency that you just buy maybe illegal stuff with. Like, it's not that anymore, okay? It's becoming more mature. So we're seeing that with Bitcoin, we're seeing that with Ethereum. And so that's one industry that people can allocate to. The other industries that people are now starting to really go into is active trading. We're seeing people actually be more speculative with picking stocks, with trading options. And I'm not a big options guy. I've traded them in the past, but I just had other commitments that I couldn't continue to, manually trade day in and day out. But you're seeing more people do that. And this is the guy I kind of end up looking like after doing that for a little too long. So I was like, all right, I'm not going to do that anymore. Yeah, because I have to be tan. I have to look better. I moved to Miami to get some tan going. I was getting too white. So with that said, people that, want alternatives, want to trade, want to do this kind of stuff, just don't have the time to do it. That's what led me to find software to trade for me, okay? So we'll talk about that in a sec briefly, but another aggressive strategy, whether it's manual, softwares, whatever, that people look to take advantage of is arbitrages. So buying something in one place and selling it in another. If I found Bitcoin for 50 grand over here and it's selling for 45 over here, I can buy it over here, sell it over here, and make a profit. But people actually do that between currencies of nations. So there's some examples here on the screen, but one of the most recent ones was the Japanese yen carry trade. Basically, the interest rates were zero in Japan, so free money, and people were investing it or taking loans from Japan, converting it to the US dollar, and then playing in the stock market, leveraging it up, and continuing to invest in US assets. So that's an example of an alternative strategy. It probably hasn't been, showcased before, but that, it was in the news and everything recently. So it's a very interesting and fascinating topic. So that's an option. The software stuff that I was talking to you about, this is where we actually leverage software to do those trades for us. And in this example that I'm going to show you here, we're actually looking anywhere between 3 to 8% per month just by leveraging our softwares. This is a monthly return table just to showcase behind, other assets compared to what our software has been generating. So on average, we've seen about 15.3% the past about 18 months or so with moderate settings. More conservative, we've seen about 3.5 to 4%. But I showcase you guys that not to pitch you necessarily a software, but to demonstrate and show you like things are changing in financial markets, and it's not just this buy and hold thing anymore. And it's partly because technology is being made more available with AI and just seeing that kind of stuff change and evolve. And this all started to really happen around 2020. So, just to kind of show you some of the stats, 3,600 trades, I took 0 of those. And these were the results of the account growth, okay? So these changes are happening due to technology. These changes are happening due to what the Fed is doing with printing more money. These changes are happening because people are also seeing the big reaction that occurred in 2020. It started to leave a lot of signs about the system and how it actually works. So again, assets have inflated. We've seen stocks, housing prices, speculative assets all kind of go to new all-time highs. And again, these technologies are being made available to really compress the knowledge gap. And which is why I love the whole concept of smart money, is that these things are happening rapid and we're gonna be able to give you access to that kind of stuff as well, okay? So I'm gonna close out with some final thoughts here. I know there's a lot of information I just covered, so this is a little bit more forward thinking, my opinion on what we're gonna see over the next 3 to 6 months. So over the past couple of years, the Fed has been increasing interest rates. Basically, we went from 0% to now about 5 to 5.25. And when the Fed does that, when they tighten interest rates and when they make them higher, what essentially they're doing is 2 things. One, they're showcasing their confidence in the dollar. They're showcasing their confidence. If you've ever played poker, it's a little bit of a bluff, right? They're showing their confidence that, hey, we can afford the interest payments on this and that everything will be okay. The second sign of it is to slow down the spending. So when interest rates are low, people spend, they take out loans, and a lot of the money moves a lot faster. So it slows down the economy when they tighten the rates, but they're trying to do it for 2 purposes. So because they've been tightening, and we've seen the interest rates up at around 5, 5.25, what we are probably going to see, in my opinion, is that with this increase, we're seeing an uptick in the demand for the dollar because people need it to actually pay back in US dollars, the debt that they took out in US dollars. And people are pricing an interest rate cut coming up in the next few weeks here in September. So what that means is because markets are forward looking and they're thinking about that interest rates are going to be cut, we'll probably see the stock market go a little bit higher. And then we'll see it, as soon as those interest rates get cut, that the market drops a bit, okay? Which is fine. Because when there's too much blood in the streets, as Warren Buffett says to invest then, the Fed starts to print money and that money goes back into the assets. So that dip that occurs is what you're seeing here. We'll probably see them start to print money after the election. Okay, so the indicators on the chart are just showing some of the changes in movements. The yellow line crossing over the purple line here, that's the RSI. Technical trading terms, basically that we're seeing the demand for the dollar pick back up again, and they're probably gonna need to print with the obligations that they have, okay? So with that said, here is the graph that I was talking about, predicting the federal interest rates being cut on their next meeting. And people bet on this kind of stuff all the time. It's kind of how markets work. The interest rates are determined by the Fed, which determines the price of money, which determines how financial assets move and where people place their money. So with that said, guys, if you have questions or anything, you guys can follow me on social media. You can scan the QR code, hit me up on Twitter, hit me up on or X or whatever, Instagram. I put this kind of content out all the time, and I love finance. I geek out about it and alternatives. So with that being said, thanks again, guys. Appreciate it. If you have any questions, let me know.